Hello and welcome to another episode of Darwin Investors. All right, so lately I've been saying I'm going to be getting into my trading portfolio and kind of show people my strategies and how I try to hedge my long positions with calls and puts and what have you. And what's been happening is that I've been going down the rabbit hole with macro, and then by the time I come back out of the rabbit hole, I've run out of time. Now, it's true that macro has been taking up a lot of the showtime that I'm recording here, but deservedly so because macro is what's driving the market, day in and day out. So today, I'm going to be kicking things off with my trading portfolio. And now, this is just a word of caution. When I talk about my trading portfolio, it's gambling, all right? It's not really real investing, but although I am trading with companies that I do want to invest in right now, things that I think are going to be strong in the days to come. I think that we're having an earnings recession right now. Like in the first quarter, we were down about 6% year on year. This quarter, we're expected to be down. Next quarter, we're expected to be down. But there are certain pockets of the economy that I think are going to be up, and that's going to be cyclicals. And so I do trade in the energy sector. I'd be happy to trade in industrials. And oddly enough, I think banks might actually have bottomed and then are ready to come back up. And you'll note certain discretionaries, I think, bottom come back up as well. That's the reason why I own Advanced Auto Parts. And I also like to own things that have high dividends. So in this video, it's just going to be a simple like how-to video on how I use options and mainly covered calls to hedge my long equity positions in order to just generate better overall portfolio returns. To describe what I'm going to talk about in chess terms in this video, it's going to be like you might see a video about chess about how to actually just move the pieces. And I'm going to be doing very little of how to move the pieces and more of how to use these moves in order to try to put yourself in a better strategic position to win the game. And that's what I'm going to be talking about in this video. It's going to be a little tiny bit advanced, but I am going to try and walk through it so that everybody can understand this. And for those of you that can manage to stay until the end of the video, I'll be doing my beer sponsorship as I pretty much always do. But this time, well, first of all, I'm gonna let the cat out of the bag. I'm not really sponsored by anyone. I'm not sponsored by beer. I just advertise for beer completely pro bono. But what I'm gonna do is I'm gonna let ChatGPT just kind of randomly come up with a funny beer sponsorship, and I'm gonna see how they pull out. Naturally, I'm pretty funny, but I'm gonna see how funny this robot is. Put them to the test and see how funny their beer sponsorship is. So stay tuned to the end because even I don't know what that's going to look like just yet. All right, let's get into this covered call strategy. So remember when I said we were going to go over a little bit of the basics of options? That's what we're going to do here right quick. Options all have a strike price, a premium, and a time to expiration. Now, these are all of the options that I had opened up yesterday at, say, around like 12 or 1 o'clock. And you can see that I had 1, 2, 3, 4, 5 options open. There's a minus sign in front of all these options that indicates that I sold these options. There's C's in front of all of these contracts indicating that I sold calls against these underlying equities. I had one contract on Marathon Petroleum, one on Chevron, one on Phillips 66, and 2 on ConocoPhillips. In the case of Marathon Petroleum, the premium was $229. Charles Schwab takes 66 cents of every one of these, so it left me with $228.34. This option expires on the 21st of April. The strike price was $133. What this means is that if Marathon Petroleum finished to say $140, on the 21st of April, because someone paid me $229 to hold this contract, I would be on the hook to sell them 100 shares of Marathon Petroleum for $133 a piece, even if Marathon Petroleum is currently at $140. Now, if on the other hand, Marathon Petroleum finishes next week at say $131, I would keep all of my shares of Marathon Petroleum and their $228 because Marathon Petroleum this contract is worthless. Why would you pay me $133 a share for an underlying equity that only is selling for $131 a share? That would be ludicrous. That's why I get to keep my shares and their money. Now, in order for me to actually sell calls on all these equities, I actually need to own the shares first to sell these covered calls. That's because I have level one access or level one privileges through Charles Schwab in order to sell options. Now, I could open up a level three options account, and that would give me the privilege to be able to sell calls on equities that I don't yet own, but that if I get assigned, I have to buy them. And to me, that's just the sort of world that I don't really want to get into. You know what I mean? That's kind of like the dark arts. So I keep it very tame. I buy it and then I sell calls on what I own. I'm hedging my long positions. So let's go ahead and talk about how to sell a call and how to sell cash secured puts using the Charles Schwab platform. To quickly demonstrate how to sell calls and puts, I'm going to use Phillips 66 as the underlying equity for these transactions. The ticker symbol is PSX. When this thing comes up, it defaults to stock, but you can go ahead and switch it to call. The action is going to be sell to open. Like I said before, each one of these contracts has an expiration date, a strike price, and a premium. The premium in this case is $1.80. However, every single contract has 100 shares, so someone would be paying me, in this case, $180 to hold a contract that Phillips 66 by the 21st of April is going to be trading somewhere above $106 a share. And so just to break that down a little bit better here, the expiration dates are on every Friday. A lot of them have weekly options. Some stocks have monthly options, and with the indices stocks like the Spider and the QQQs will have almost daily options. However, these ones tend to be weekly, seem to be kind of like the norm for the most part. So, and they expire every single Friday. So this one would expire next Friday. And what this says, if Phillips 66 is below $106, say $105 a share, I get to keep all my shares of Phillips 66, and I get to keep their $180. However, if Phillips 66 is say $110, I have to sell all 100 shares of my Phillips 66 for $106, even though the underlying equity price is currently trading at $110. And that's the reason why they pay me $180 to hold this contract. Similarly, there are ways to buy stocks. Now you can just go ahead and just buy stocks. Say you want to buy 100 shares of Phillips 66 and you like this price, that would just be a market order right there. And they would say, okay, that would cost you $10,650, I guess, somewhere in there. Because what they're doing is the ask size, and that's, if you ask for market, that's what you'll get. You can also do a limit buy, which would say, all right, well, I like the stock, but if it's $105 a share, then I'll go ahead and buy it. And if sometime during that trading day that it hits $105, the thing will automatically pick it up for you. But the third way that you can buy stock, and this is the way I buy almost all of my stock, is to sell puts. And so what I would do is I would sell a contract that would expire here on the 21st of April with a strike price, because I don't want to do right here. I'd say, how about $104 strike? I don't mind that. And then somebody says, okay, I'll write that contract for you. I'll buy that from you. And so somebody sends me, I write the contract, and then somebody gives me $75 to hold this contract. What this contract says is that if Phillips 66 is $106 a share still next Friday, I get to, I don't have to buy any shares, and I get to keep their $75. However, if it falls into like $102, I have to buy 100 shares of Phillips 66 for $104, but I also get to keep their $75. So it brings my cost basis down to $103.25 a share, because I've already collected some money on this. Now, that's the way I prefer to do it, is because it's kind of like that old name your price tool on Priceline. I like the $104 price, I would say, in this case. Realistically, I'd want Phillips 66 around 98 bucks, but for the sake of this example, I'm saying I like $104. I like it a whole lot better than $106. I'm willing to wait for this and see what happens by Friday. If it's below this, I'll go ahead and pick it up for that, because I like that price anyway. And that's what this says, and this is the way I tend to pick up pretty much all my shares in my portfolio have been picked up through selling puts. All right, we're getting there, folks. We're almost through all the basics here. Let me just cover a couple more topics before I get into exactly how I sell options in order to hedge my long positions or lower the cost basis on my underlying equities. So a couple more terms to know here is in the money, at the money, and out of the money. That's how options strike prices are defined. An option is considered in the money if, in this case, a covered call would be in the money if the strike price is below $106, meaning if Phillips 66 is sitting at $106 and I sell a call at $105, I'm selling it $1 in the money, meaning that I believe that Phillips 66 might go down to 104 by next Friday. Let me see if there's any takers. It could go up and then I lose all my shares for $105. However, it could go down, in which case I'm making money on the equity on the way down. And I'll demonstrate more of how this happens here in a little bit. And that would be an in the money call. Out of the money would be some strike price above $106, say $110. And an at the money call would be roughly $106. Now, you may hear me talk about at the money calls. And then let's say Phillips 66 is $106.26. I say at the money $106. And that's because I generally will just say it's at the money if it's in with like a buck of where it is. If it's 106.50, I sell it for 106. I'll say that's at the money. It's 105.50, I sell it at 106. I'll say that's also at the money. I tend to give a little bit of leeway. It doesn't have to be 106 right on the button. So I call things like within a buck, at the money. Now, the next topic is very important to understand when we're discussing the cost of premium, and that's the intrinsic and extrinsic value of the underlying option that's being sold. The intrinsic value is a relation between the strike price and the underlying share price. So let's go ahead and look at Marathon Petroleum here. It's sitting here at $133. I can tell you right now that Marathon Petroleum is currently trading at about $130.75. So why would this contract have a market value of $106, even though this contract is currently about $2.25 out of the money? And the reason why is because this time to maturity, it brings it extrinsic value. Because it has another week to go, it's got time, and it's also got volatility. And that volatility right now is worth $106. It currently has no intrinsic value because this contract says it's got to finish over $133 for it to be of any value to the buyer of this contract, and this equity is currently sitting at $130.75. Phillips 66, on the other hand, is a different story. It expired yesterday. It had a strike price of $104 on a covered call. It was currently, as you remember, sitting at $106.26, meaning that at expiration yesterday, this had $226 of intrinsic value. It was $2.26 in the money. But at the time of this screen pick, it was worth about $142, meaning it was about 2 hours from close. So this underlying equity would have been about $105.30, meaning that 130 of this would have been intrinsic value, and the other $12.50 would have been the little bit of time that was left to expiration and the volatility that was left in the option in that 2 hour time period. So that's intrinsic and extrinsic value. Let's go ahead and look at cost basis. And cost basis is very important because this allows you to set a strike price that makes it so that you don't lose money on your shares should they get assigned. So it's the reason why, if you look back here at any of these strike prices, I didn't mind letting go of any of these at these prices, because if they sold for these prices, I still make money. I may not make as much as if this thing gets squeezed and goes straight upward. However, I still make money on all of these stocks because my cost basis is below these strike prices. And that's the power of covered calls, and it's also the power of dividends. Dividends also help with cost basis. Let's go ahead and have a closer look at cost basis. Let's go ahead and use the example of Phillips 66 when we're talking about cost basis here again. We're going to say that we're going to sell a put, and remember that gets me shares, and that expires by next Friday for $1.43 a share or $143 a contract. And what with the strike price of $106. And what this means with $1.43 a share, that my strike price would be $104.57 a share. That's essentially what I bought it for because someone has already paid me $143. So my cost basis is 106 minus $1.43 or $104.57. If I then get assigned these shares for $104.57, let's say I didn't really want them for whatever reason. You should only sell puts on stuff that you want, but let's just say for the sake of argument, I didn't want them. So now I've got my cost basis is $104.57. So now what I want to do is sell an at the money call on it, let's say for $104, but then because I sell it for $104, then I'm going to get a covered call on it. I get money for that. And that, again, lowers my cost basis down. If in this case, it would have been $310. Now, this is in the money by $2.26. 226 of these dollars would be intrinsic value. The rest would be extrinsic value. So for the sake of this example, let's bump it back up to $106. And that would give you more of an idea of what this would cost at the money. Now again, 26 cents or $26 of this would be intrinsic value, and then the other $154 would be extrinsic value. So the $180 here would actually lower my cost basis again. So if it was like $104.57, once I sell this call, my cost basis would be $1.80 a share less than that. Sorry, my math isn't so quick that I can figure that one out. Let me see, I guess that'd be about $102.77. So that would be my new cost basis. So any call that I would sell above 102.77 would be break even after that. And that's kind of the way this works. So basically, selling calls, getting dividends, and collecting those premiums lowers the cost basis on what it actually cost me to make a profit on this stock. I hope that made some sense. That was a lot of numbers. All right, so if you got to this part of the video and that's all the basics, congratulations. I know that was a lot of information, but what we're gonna do now is we're gonna switch gears a bit and we're gonna talk about how we use all of those like options fundamentals to try and implement a little bit of art, and let's see how can we maximize our returns using our knowledge that we have right now. So part of this comes to, when do you close an option? And so I close an option, now this is just my own personal rules. Everybody does this differently. There's no right way or wrong way. But I close an option when I believe that I have the advantage. Sometimes I may never close it if I don't think I have an advantage. Although that's so rare. I'd have to be on vacation or something, probably, just not paying attention. But by and large, I'm always gonna close it when I'm about 70, maybe 80% up. I'll close the option, or I'll close it really early when I believe that I think that I can actually resell it again. I can collect a little bit now and then resell it again and collect a lot more and set my strike price even higher, put myself in an even better position. So I'll always close it when I think that I've got the advantage in the deal. And so let's go ahead and look at the options that I had opened up yesterday. So when we look at this here, I can either look at this as 5 separate options, and that's one way to look at it. Again, I would not be unhappy if all of these were assigned to someone else at the prices that I had sold them for, because that's the reason why I wrote these contracts. I like those prices. I'm going to make some money. However, when I look at this, you can look at it as 5 different ones, or you can look at it as one big aggregate or composite score here, where I'm up $64.20 on the whole. And that's the way that I tend to look at it. At least in this case, I looked at it as an aggregate. I said, okay, I'm up $64. Let me take a look at oil today. So I went to the internet and I looked at CNBC and I said, all right, well, the Dow Jones and the NASDAQ and the S&P are all very red right at this moment. How is oil doing right now? So then I clicked on the oil tab and I saw some headline that said that the IEA said there's going to be some sort of supply shortage. oil was up, yet all of these stocks were down. And you can tell that the stocks were down because you can see that this is a green number on the day. So covered calls go up in value when the stock price goes down. That's why it's considered a hedge. And because oil prices were up and the stock market was down, I thought that these might rebound by the end of the day. So I'll go ahead and take my $60 and then I'll go ahead and resell them at the end of the day at a strike price even higher than where I have it right now and give myself, just that much more of an advantage. So let's go ahead and see how that worked out for me. So like I said, I did sell them at about 2 hours from close. I made about $64 on the aggregate here. You can see that my quantity at the end of the day on these five contracts is 0. But if I had waited until the end of the day to close them out, it would have cost me $797. Instead, I closed them all for $674. Closing them for $674 netted me $64. If I had waited at the end of the day, it would have cost me, actually it would have cost me $60 to close them all out. I probably at that point would have just been let someone else get assigned my Phillips 66 shares and then just let's let this ride out until next week on the other 3 contracts. I wouldn't have been willing to probably lose any money on those because why lose money? Because I was going to get $65 if I let Phillips 66 get assigned, and I was happy with that price. I'm happy with all the prices on the other strikes. Why close it out at all? And the only reason why I closed these out was because I thought oil would rebound at the end of the day, and obviously it did. And I thought the whole stock market would rebound by the end of the day because the sentiment this week has actually been good. The pullback yesterday was just because it went up so much on Thursday because of that positive, I guess would have been negative PPI news, but negatives or positives right now or whatever. But that day, it caused a lot of people to think, well, inflation is going to come down even more. It's going to come down much faster. Certainly these Fed people are going to come to their senses, lower interest rates, causing the stock market to go way up on Thursday. And yesterday was just a little bit of a pullback. However, I did think that because of the positive sentiment that the market would rise going into the end of the day, and in fact, that's what it did. So what I did was I set my little alarm on my phone for about 3:45, which is about 15 minutes before close, and then I rolled all the options and just resold them all for $586. And here's a closer look at what I did for everything here. So I bought all these out, made $60, and then I resold everything for, it looks like $802.72. Now, some of this can't be counted because the Schwab one wasn't in the original composite there, nor was the 2 advanced auto part contracts. So taking those aside, it was $586 I resold it for. However, look what changed. Instead of having $172.50 strike, I now have $175 on Chevron. So if this gets assigned, I made another $250 and I got $68 for that one. Marathon Petroleum, I lowered from 133 to 132. Truth be told, if it went for 131 or more, I'd be really happy. So I was happy to roll that one down, and I pick up another $156 there. Phillips 66, I rolled from 104 to 106, picked up $169 there. And then I rolled ConocoPhillips from 109 to 110. So I was able to make $60 here, resell everything, and bump up all of the strike prices on my underlying equities, with the exception of Marathon Petroleum, because I just don't see it finishing the week over $131. It could, but it just never seems to happen. Now, Schwab is an interesting one because you can see that Schwab is 54. I set a call for $54. It's currently trading at $50 and like 75 cents or something like that. But I got a huge premium for that one of $103. And the reason why I got that premium was because of the volatility of Schwab. One, it's a bank and those are really volatile, but the second reason is because it reports earnings on Monday morning. So what I'm saying here is I did get Schwab for $52 a share, but I sold a put of $1.10 or $110. So my cost basis is $50.90. And so if it sells for $54, I make $310 on the shares here plus this $103. So I make $410 on my little Schwab trade over the course of about a week. And I would consider that a win. Now, if Schwab after earnings goes up to like $58 or $59, remember, I still have to sell it for $54. I'm saying that by next Friday, it'll be below $54, or I have to sell all my shares of Charles Schwab for $54, even if Charles Schwab is sitting at $57. Again, the premium was really high because it report earnings on Monday. Now let's have a look at how selling calls, puts, and dividends has an effect on the cost basis of my equities that I have. So let's go ahead and look up the trading history here. We'll look up my Phillips 66 position here. We can see with Phillips 66, I originally got it for $104 a share. I did get a dividend of $105. It means my cost basis on this is $102.95. If you include all the options, it's probably still about that. I haven't done that great with Phillips 66. But if you include all the options, my cost basis on Phillips 66 is $100.96. And that is all despite the fact that I never once bought a share for $100. I only ever got them for $104. I got them when I was assigned after I sold a put right here. If we take a look here at Chevron, we don't say, okay, don't include the options, and we say, Chevron, what's my cost basis? We can see that my cost basis on this is $180.07, and that's without all the options. I originally, looks like, bought it on the 27th of January for $181.82. I sold it for $182.74, made a little bit there, but eventually I put in a limit buy for $182.50, and I was paid a dividend of $151, bringing my cost basis to $180.07. If I include all of the options that I do, and you can tell I'm a pretty active trader when it comes to this sort of thing, and this is since the end of January, so it's been a little while, my new cost basis is $174.27. So I bought them originally for $182.50, got dividends, sold options, and now I'm sitting here at $174.27. Remember, the option that I have open right now, the covered call that I have open right now, has a strike price of $175, which is above my cost basis price. So I don't mind letting go of it for $175, even though I originally bought it for $182.50. I'm not losing $750. I'm making a little bit of money. All right, so that's all we're going to do for this video here with cost basis and all that sort of thing. And thanks for making it this far. Now we're going to talk about ChatGPT, and we're going to see if that robot's as funny as I am. So let's pull that up and see what happens. Sometimes I think I make these videos just for these beer sponsorship type of videos. But all right, ChatGPT, I pulled it up. Write a funny beer sponsorship. And we'll let it write one, and then I'll just see if it's as funny as I am, and I'll just let this fly, and we'll see how this goes. We'll do it live and in person here. Let's see. Introducing the all-new Beer Belly Brew, the beer that makes you look more fit and attractive with every sip. All right, I like it so far. Our secret ingredient, its patented blend of hops, barley, and pure imagination. Don't believe us? Just ask our spokesmodel, the Beer Belly Babe. She's proof that you don't need a gym membership when you've got a 6-pack of Beer Belly Brew. So if you want to impress your friends with your newfound 6-pack abs, grab a Beer Belly Brew today. Just remember, results may vary. All right, that's what I have to work with. Yeah, it's not bad. We'll give it a shot. Guys, are you looking to get rid of that flat stomach and looking for something a whole lot better? The ladies find it appealing. They may even hunt you down in the grocery store. Have I ever got the product for you? It's my sponsor this week, which is beer. Come and get me, ladies. All right, the beer that I have this week is Juicy Little Thing IPA. It's by Sierra Nevada, and I have to unapologetically give this beer a full 3 Kate Rooney's out of 5. Anyway, have a great week, everybody. See ya. Bye.